Thank you so much. It's the last panel for today, and we are going to be talking about something that's slightly different, but extremely important, on climate adaptation. And I know some of you have traveled from different parts of the world, and we might experience extreme weather events slightly differently. Wildfires, storms, floods, maybe even extreme heat here in Singapore. But I think what we can all agree on is that these extreme weather events are happening more severely and more frequently. So I'm so excited to have our speakers here today who have flown in from the US and Philippines to talk about how we can get from risk to readiness. And we're going to dive into 3 segments. First, understanding the problems. Then, the solutions, how technology and innovation is really helping to shape this space. And lastly, the role of financing as well as policy in helping us to close this adaptation gap. So I'll start with you first, John. As the head of sustainability of Goldman, help us to frame the problem here, right? Help us understand what exactly are companies, businesses, banks, asset owners faced with physical climate risk. And don't just stop at the direct risk, but maybe help us understand the indirect risk as well, second, third order impacts that we might be experiencing here in Singapore from a wildfire that's happening in the US, for instance.
Well, and look, I think you're getting into part of why some people are fleeing with terror, because this is not an easy problem, right? And I could talk about time horizon, right? Big impacts on multiple vectors globally across a long and complicated time horizon, but I'm not even going to get into that, right? 3 vectors I'm going to talk about in terms of understanding the problem and its complexity that are important to get started. So number 1, there's a really important distinction between acute and chronic impacts of physical climate change. And so acute, you talked about a lot of disasters, but I think what's less discussed are some of the more persistent chronic issues. And my little light bulb moment came. I was talking to an insurance broker, and they help companies in the United States buy insurance for their employees. And one of the things they saw is the insurance rates for a retailer they worked with in the Southeast were going up, 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 up because of workplace absenteeism from chronic heat. Right? I was talking to an insurance company in this part of the world, and I thought we were going to talk about property and casualty insurance and losses, and they wanted to talk about what was happening with their actuarial tables because of health insurance, right? So step 1 in the complexity of this is acute versus chronic. Step 2 is this direct versus knock-on effects. And I was working with a chief investment officer of a pension fund in a state in the US where I think it is technically illegal to talk about ESG and sustainability. And they want to talk about physical risk. This is an issue that they see. And they said, what I really want to know is, step 1 is, who's holding the bag, right? Who's holding this risk? Is it the insurers, the reinsurers, the cat market, or government? But then, what are those knock-on effects? If property insurance goes up, what does that do to home values? What does that do to property tax rolls? What does that do to municipal finances? What does that do to economic growth? Those knock-on effects are significant and highly, highly complex, and that's not even getting to the value chain, the supply chain element. So that's complexifying factor sort of number 1, this acute versus chronic, direct, indirect. Number 2, though, is what's your level of resolution? Are you looking at an asset? So the simplest thing to do is look at a big physical asset, and infrastructure and real estate investors have been doing this for a long time. If you're going to own a big piece of stuff in a fixed physical location for a long time, evaluating it, mitigating it, managing it, the ROI of mitigation is high, the analysis it pays to get data, all those things. That makes sense. What about a portfolio? A diverse set of assets, and I'll talk more about this later, but a diverse set of assets on a global basis, different asset classes, different level of resolution, different ways to apply the data. And then at a macro perspective, there's a sovereign wealth fund I work with that said at the end of the day, all that stuff I just talked about is so complicated, they're not going to even try to do anything at a security level. They want to understand the impact on their capital market assumptions in terms of inflation, growth, and interest rates. And we've actually partnered with a data provider to think through how does this change capital market assumptions on a global basis. So that's challenge number 2. What's your degree of resolution? Challenge number 3, this is not the only thing going on in the world right now that makes life a little complicated and really puts a primacy on resilience, right? Think deglobalization, think trade, think conflict, all of these elements. So back to what problem are we dealing with, right? We're dealing with the stuff that's visible, that's in the headlines, but you need to break it down in terms of those 2 initial factors. Is this acute versus chronic? And is it direct or knock-on? Second of all, what's your degree of resolution from an asset to a portfolio to the world? But then finally, how do you contextualize it? And this is particularly important for investors in navigating a complex world. We'll get to the punchline later, which is that's actually good news. It puts resilience and sustainability much more center stage in a way that makes it more actionable.
Great. Yeah, I like the point about the knock-on effects, because actually it's a global problem that actually is affecting most of us, even though we don't even realize it. And I would like to turn to you, Scott, to talk a little bit more from the perspective of Asia. Help us understand, like, what is the problem of physical climate risk in Asia, and maybe help us explain the nuance, especially because a lot of countries in Asia are developing at different stages. Where do you see are the biggest financing gap when it comes to climate adaptation?
Sure, thanks, and thanks for the opportunity. It's good to be here. So you asked for nuance, and there is nuance to it, but in a sense, there's also the unnuanced version, which is, across Asia and the Pacific, these countries are already realizing tremendous impact, economic impact, from climate-related natural disasters, and we estimate roughly $50 billion a year in damage across the region. 90% of that is being realized in our upper middle income countries, recognizing the value of economic assets in those economies. But it also points to the challenge here. These are relatively higher capacity countries with more resources, and yet they're still seeing this level of damage. We also identify an investment gap around protective measures of upward of $70 billion a year. So in terms of how we evaluate those gaps and understand the nuances of it, I mean, I think we think in three basic categories, and particularly with emphasis on our long-term goals. And as a development bank for the region, we really invest for the long term, even as we try to help them manage very near-term and even immediate crisis environments. But for the long term, this is really about risk reduction. And in a sense, it goes to the bread and butter of who we are as a development bank, is that we invest primarily in infrastructure. So much of this agenda is working with our government clients around making the key infrastructure investments that will protect them better against these natural disasters. And to do it smartly. So it's not necessarily recognizing that much of this is flood risk. It's not necessarily pouring a lot of new concrete. It's actually finding nature-based solutions, which will be sustainable over time, and working with our clients around those more holistic approaches. But that's a long-term agenda. It takes time. So we are also focused on how to work with our clients, again, primarily governments, but increasingly private sector, around where they have to bear the risk. How do they do it in a way that is aligned with their fiscal realities? That is an increasingly pressing problem. These are countries that already have reduced fiscal space coming out of a crisis from 5 years ago, the pandemic, and are now facing a renewed round of economic shock. So working with them when these events happen, how can they respond fiscally? We have our own instruments to support them in that, in terms of fast-moving fiscal response. And then finally, a third category, increasingly important from this perspective, recognizing that governments are constrained, is risk transfer, and looking to financial markets so that governments can use these products to offload some of this risk. And we see exciting opportunities here. We are listing here in Singapore 2 brand new catastrophe bonds for the first time linked to precipitation in terms of the parametric triggers. So we're excited about those kinds of solutions, but it's really all three of those layers working together that we see as sort of what's needed for our clients.
Yeah, great. Thank you so much. And Abhishek, turning to you next. You are the CEO and co-founder of AI Dash, and you're doing really great stuff, not just because you have AI in your name, but because you're helping a lot of utilities in the US help to predict wildfire and storm risk, right? And you're using AI technology and satellite data to be able to do so. So tell us, right, how is technology and innovation shaping the way how companies are thinking about climate risk, right? And actually doing it a lot more preemptively before it actually happens.
Yeah, this is very interesting. And yes, AI is our name because in 2019, AI was not as popular as it is today. Now everyone believes on AI. When we talk of how utilities and other industries are using AI and satellite and these technologies to prevent risks, let me give an example. Let's start with wildfire. I live in California. Wildfire is a big problem. Theoretically, wildfire happens every day. We are not concerned about that, but there are certain major wildfires that happen which we are concerned about. So the question is to prevent that wildfire, what can we do using technology? Let's start. Wildfire happens if there is a trigger event. Now, in the context of electric utility, a trigger event can be a tree touching the power line or a poorly maintained asset getting a spark. So if we are able to predict or see a tree and depending on the wind condition identify that it can touch a power line in this situation, we can trim the tree. If we know that this asset is likely to fail, this transformer is likely to fail, we can proactively maintain that. That reduces the risk of the trigger for ignition to cause wildfire. That's first step. The second, if this ignition actually happens, the spark trigger actually happens, is there's a small spark that falls on the ground. So the second step is, can we monitor the ground and identify the fuel load? If this spark falls on concrete, it will not catch wildfire. So using satellite and AI, we can today monitor every point on Earth once every 24 hours. And in 2 to 3 years, it will be once every 1 hour. So we assess the fuel load of the ground to predict the risk of an ignition trigger causing an ignition if there is fuel load. So that is a preventive action utilities can take. They can remove the dry grasses. Next, if the ignition has happened on the ground, will it spread? That requires understanding the real-time fuel load and connectivity of the fuel, which is again something that can be assessed easily using satellite and AI. The last and the foremost is consequence. Wildfires do happen in Alaska, in Alberta, in many places which are routine. These are natural wildfires that are supposed to happen and they have benefits. But in this case of man-made wildfire, because of electric utility failure, the consequence is to the people who are living. So we can assess what are the people who are living, and if we foresee a fire coming in next 3-4 hours certain place, can we proactively use bots to create a clearance, remove those grasses and bushes and create a barrier for wildfire to spread? That will reduce the consequence, yes. So this is how holistically all this AI and satellite-based technology, as the technologies combined together to make decision on each and every aspect of reducing wildfire risk. Storm would be something similar.
That's great. And we started this panel obviously talking about all the problems, which was quite grim. And now I'm getting very excited about the solutions that are out there. So, John, keep me optimistic here.
Yeah.
Like, are you seeing a lot of other cool solutions out there? Like, what have you seen from a technological and innovation standpoint in terms of solutions that can actually help companies preemptively think about climate adaptation?
So yeah, and I think you're grounding this in such an important point that sometimes gets lost out in this conversation, which is the mirror image of risk and loss is ROI for solutions businesses, right? Which is you have no market, you have no TAM without some of these challenges. And I think it does create real opportunities for businesses and innovations. And I'd sort of go through kind of 3 levels of these, right? So one is we're seeing, and I think you were getting into some of this, a really interesting emergence, sort of almost resilience tech ecosystem, right? And it has multiple layers from kind of a pure data layer, which then also then cascades down to an equipment layer in terms of sensors and other tools, and it could be around fire, flood, water, a whole host of other issues, to actual things that get much more into the built environment and the services layer, right? So I think there's a whole emerging resilience tech space I think we found excited. You know, fire tech is its own field now, right? Literally, there's a venture capital fund that all they do is fire tech, right? And so these things are all emerging. The opportunity and the challenge there is we see when we step back broadly a lot of investors that want to invest in climate solutions, whether it's on mitigation or adaptation, may only have a modest risk budget for venture capital. Right? And so they want things that are a little more proven, a little more secure. And in some ways, the good news is we find a whole bucket of investments we call twofers. Right? They're investments that have a robust value proposition today, generally rooted in mitigation, but have a significant adaptation application that is, from a financial perspective, another growth tailwind. And from an impact perspective, it's allowing people to double down. So I'll go through a couple of sectors where we see those. Fundamentally, agriculture. Sustainable agriculture tends to be things that need an ROI today, right? So we've invested in a company that does more precise irrigation for permanent crops. It has a sensor combined with data to much more precisely measure and manage irrigation. So it allows you to save money, to save water, to save carbon, and improve crop yields. Good proposition today from a climate perspective and for their customers. But with heat, with drought, with flood, suddenly the ROI on that product goes much, much higher. And we see that dynamic largely through a whole host of innovations up and down the agricultural value chain. That's number one. Number two, nature-based solutions. I think Scott was talking about this. We're invested in a wetland mitigation banking company. Once again, good, regulated, required service for people today. Added tailwinds as people build data centers and other things. And so it saves carbon, good for species, good for habitat, but makes landscapes much, much more resilient. The third sector is honestly anything touching water. So if you go to our website, we've published 2 recent pieces on water as just a fundamental growing need, from an infrastructure to a technology to an efficiency to the commodity itself. I think that's an area that similarly has this dynamic. As water stress, water scarcity grows, that value proposition today becomes a more robust value proposition tomorrow. And finally, there's a whole services layer to this. This requires not necessarily pouring a bunch of concrete, as Scott says, but there is a services engineering, and whether it's hardening existing infrastructure, making it more distributed and resilient. We had bought a company that does engineering for power grids. Great for making them more efficient today, unbelievably important for hardening them into the future. So those twofers, I think that's that second type of business model. And finally, and Scott may talk about this a little more, financial innovation. I think we invested in a bond that ADB issued around glacier melt and awareness, right? We're seeing new financial instruments that create investable ways for folks who may not even invest in private assets. They might not do venture capital, they might not do private equity, they might not do infrastructure, but they can buy bonds. Right, so there are ways all investors can participate in this market.
Great, I love the examples and the variety of it as well across agriculture, nature-based solutions as well as water. And I think one of the points you mentioned was that some of the risk budgets sometimes are not as great as we hope it would be. And actually it's interesting because if you think about it, it often costs a lot more if you deal with all these physical climate risks post-event, recovery, right? Rather than attempting it early on as a preemptive measure. So, Scott, I guess my question to you is: do you think that there are, further incentives, whether it's from a policy or even from a financial lens, right, that could actually incentivize a lot of businesses to think about this earlier on, so prevention rather than cure, right?
Yeah, no, that's right. I think that's the right target, and I will say, I think part of our model increasingly is to engage in the upstream on the government side in a way that creates the right incentives for private sector. For this agenda, a lot of that does start with data generation and better data. So how to, markets will function, insurance markets will function better in our developing member countries when they have more precise data around the nature of the risks. It also helps the governments themselves choose the right kinds of products that are best targeted, so they're not overspending in the absence of enough information and overpricing of risk. So a lot of our agenda, I think, we are pushing for better data. Technology plays a big part of that, and I think there are some really exciting solutions around that. But it is, so much of it is also about helping governments address, you're right, none of these countries are interested in paying more to address the outcome of a natural disaster. It is the challenge of mobilizing the capital ex ante to get the kinds of investments that ultimately will lower costs. So we are working, we've created platforms here in Southeast Asia with ASEAN. We have created a climate platform for finance ministers so that they can do better fiscal planning, that their prudential approach is better informed, that they share best practices around this so that they can start to build in to their own planning efforts clearer costing of risks that actually can create the right incentives for private sector investment, but for their own investments, that they can make the case, including to their public, why this is a good use of fiscal resources to make what are truly very large investments up front to protect against future risk.
Thank you, Scott. And you also mentioned briefly the point about data, which actually was a perfect segue for me to ask Abhishek about your views, because I guess there's some skepticism still in terms of the reliability of data, right? Especially if you're using AI, climate intelligence these days to be able to help make a lot of critical decisions. How do you actually build trust in your customers that a lot of the models that come out from your data is actually reliable and accurate, as a lot of these utilities are making real decisions, right, whether to cut power supply or not, for instance?
Yeah, this is a very important question, and we all know about all those AI tools which dream and tell something which doesn't exist, right? So when we look into AI, what is the quality of data that goes into training is most critical. Has the model which we are using seen enough diversity of data is second most important aspect. Like for example, in case of AI Dash, our model is trained on all 50 US states. So that brings certain level of trust. The third aspect, which is even more important, is explainability. Yes, model can make a prediction that this is likely to happen. But is the prediction correct? Or is the model hallucinating? It becomes very important. And that is where explainability comes, and this is important. There's a utility in California which is undergrounding 10,000 miles of line in most wildfire risk areas. Now, this question of which 10,000 miles are most wildfire risk is a prediction which has probably come from some data, some AI, some intelligence. Imagine if the prediction itself was wrong, the entire dollar is wasted. And this is actually $30 per customer per month, which is a significant amount of money invested based on data. So explainability is important. Good news is that there are AI architectures today where we are able to sieve inside the model to find why that prediction has been made. So using that right set of data, right set of AI platform, and making predictions with explainability, that is what is important, and that is being done. And fortunately, in the last couple of years, AI has advanced to make it much easier than it was 2-3 years back.
Thank you. And I think we have a question from the audience. I'm going to pull that out, and this one goes to you, John. How can climate adaptation attract more capital from the private sector rather than relying on government and philanthropic capital? And maybe help us understand also, are projects today bankable, right? Do investors, especially from private capital, think of it as commercial, right, to be able to finance?
I'm going to give a spectacularly helpful and precise answer, which is it depends. Right, and I think, look, in some ways, it's similar to when we think about climate solutions, which is you need one or both of the following things. You need a robust, necessary customer value proposition. I think this is a lesson learned. When interest rates were near zero and inflation was near zero, people said, we'll buy luxury goods, we'll pay a green premium, we'll buy that insurance for an overly rainy or not rainy enough day, right? And now with inflation higher, rates higher, you need a value proposition that's robust and resilient, and generally it means you're doing one of two things. It is either something that saves your customer money, or is something they have to buy, right? And back to this value proposition. So this is investable when you have a business that has a core value proposition that makes sense, or it's backstopped, like the Glacier Melt Bond, by a robust balance sheet, right? And in some ways, it's sort of normalizing this relative to any other investment issue, which is I don't think this is harder or easier to mobilize capital. It's kind of the same pitch, but we got to get back to basics, right? Just because something is called a climate solution doesn't mean it's going to raise money, right? Just because something's adaptation doesn't mean it should. We have to get down to those basics.
Scott, ADB aims to deliver over 100 billion in cumulative climate finance up to 2030, and adaptation is now an increasing focus area. So what are some of the big projects or focus areas that are exciting? Where do you think are some of the biggest opportunities for public and private partnerships in sort of adaptation?
Yeah, thanks. And this is key about how we see the role of the private sector. Because you look at that $100 billion number, that's a commitment of our own capital, but we're a lender. And again, to the degree that we mostly lend to governments, we're operating in an environment where capacity to borrow is constrained. You know, as interest rates rise, our interest rates rise for our borrowers. So increasingly, we're focused on steering them toward purely private sector solutions, and we have instruments where we can work directly with private firms, and helping governments identify where there is an economic return to these investments in a way that there's a private solution that they don't immediately have to default to borrowing from an institution like ADB to do a public infrastructure project. And then PPPs are sort of a middle space that I think we see growing traction for. You know, in our home country, the Philippines, where, you know, again, these flooding events have been severe and frequent. The damage is very high. You know, they are undertaking a very large scale of investment about better flood protection, but they are fiscally constrained. So, you know, it is a country where actually we are doing a lot in terms of PPP, including advisory services about how to navigate this kind of investment model, and really with good success. So I think a lot of our agenda is helping on the government side our clients evaluate where there are opportunities with projects that do generate a return that can be captured by private investors. So even in something like flood mitigation, in terms of water systems, we do see private interest, certainly in the ag sector. There are a lot of opportunities there. We have good success in even lower income countries like Laos PDR, Cambodia, with that kind of investment. And then again, you know, in our bigger countries like Philippines or Indonesia, much of the focus really is on, at a system level, what the enabling environment looks like for these investments, so that it doesn't always have to be framed squarely as a public, you know, the goals are public, but it doesn't have to be a public investment agenda. So if they can get smarter regulation, more of an enabling environment, you can unlock those investment flows.
Something that John mentioned earlier is that insurance cost is rising, right? And Abhishek, my question is to you. Maybe explain to us how have you helped some of your customers, like your utilities, actually with their insurance premiums, right? By using some of your solutions, for instance. Has that helped them in terms of understanding the risk better, and therefore, you know, being able to sort of lower that insurance cost?
Yeah. So basically, electric utilities have certain predefined budgets. They get approved every 3 years, and they are rate-based, right? Now, using that dollar, how much risk we can reduce will determine the insurance rates to a good extent. And that requires intelligence. So if we are able to identify our worst situations, areas where we need to perform to mitigate the most, and we fix those, if that information is easily available for insurance to see, for regulators to see, the insurance premiums are expected to go down. And we have seen some of these happening with support of both insurance and the regulatory bodies in some certain states like Texas. So Texas, for example, is capping a liability on wildfire if utilities take certain mitigating actions as per their wildfire mitigation plan. So such proactive activities is an example of how kind of risk buy-down can happen by use of technology, use of predictive insights, and taking mitigating actions even before those risks negative events happen. And hence, insurance premiums get reduced. We are seeing a lot of cooperatives. Typically, co-ops are very small, right? And wildfire can completely destroy a large utility, forget co-ops. And they don't have money to invest so much. So we are seeing there are insurance companies like Federated, which are enforcing these co-ops to buy certain solutions, like, for example, AI Dash and others. If these utilities, they buy these solutions, the insurance premium across all the co-ops in that state or in that jurisdiction gets reduced. So this is already happening.
I'll pull up one more question from the audience. And I think this is probably for you, John. Do you see corporate America slowing down their climate adaptation spend? Which country or sector, I guess, do you see meaningful progress in keeping to their commitments?
Yeah, I actually don't see that.
You can't say it depends.
I don't see it's, well, it's also true, but I actually don't see the adaptation spend slowing down, right? I think the reality, it's when there's an ROI, and whether it's a product or service, they see it. And I see the same thing with investors. I think the big thing with this, from both a corporate perspective and from an investment perspective, is going from a reporting obligation that maybe shows up in your TCFD report or something like that. It also gets you in the wrong mindset, where it's around data, it's an obligation to, okay, actually, how do I really do this, right? And step one is a framework. Let me think more holistically about risk, opportunity, and margins, right? It's about the economic translation mechanism. And then how do I take the data I have at my disposal and suit it to a use case? So for corporates and investors, often it starts with big owned physical assets. I'm going to look at an infrastructure asset. I'm going to build a new headquarters. I'm going to have a data center. Let me analyze this thing and figure out pricing mitigation. And that's where it started. But that's a small portion of what most people own. And when I talked earlier about the scale question, from a single asset to a portfolio, like that's where it starts to get complex in how we use data. And one of the things people ask about, what's the financial innovation? And for me, it's less around innovation, it's much more around application. How do we find tangible, practical use cases that take the quality of data to an actionable use case? So I'll give you an example. We had an insurance company that says, I have some physical risk in the liability side of my business, so I'd really like to manage it on my asset side. I've done it for my real estate. What about my corporate bonds? Overwhelmingly, I own long-dated corporate bonds. We said, it's perfect. Long dated, so maturity matches the risk. Diversified portfolio, which means there's some fungibility across assets. So we said, the data, when we look at it, there's some stuff that doesn't make sense, but is it good enough to say if we find a concentrated tail of securities, we can create a don't buy unless you love it list of bonds, right? Which is, if you can swap out an equivalent, it's actionable, right? The portfolio manager knows what to do. It's suited to data that's not going to be 100% right, but is it going to be 60% right? That's good enough for that use case. And so in some ways, it's really boring. It's a very practical application, but back to what innovation needs to happen at the corporate sector and the investment sector, I think a lot of the innovation, frankly, is in going from a theoretical reporting abstract need to a roll up your sleeves, do the work, and where can I apply it relative to the data at my disposal in a way that adds value to my portfolio or to my business.
Great. So I think we're coming close to the end of our panel. We're really standing between you and cocktails. I think we did talk a lot about how adaptation is no longer optional, right? It's actually something that is almost existential for a lot of us. We talked about how actually there are a lot of solutions, right? Interesting technological advances, but also the role of financing, as well as regulations and policies in terms of helping us to close that adaptation gap. I think final question for the speakers, if you had one wish, right, in terms of what one action either corporates or governments or investors can do to really help close the adaptation gap, what would that be? And maybe we'll start with you, Scott.
Yeah, so one which I think I'll stick with my message, which is so much of our focus is on government action, and particularly in ways that are sending the right signals to private sector. One thing I will say, in listening to the prior panel on carbon credits and climate mitigation, the one key thing that this adaptation agenda has in its favor is in a sense politics. That these natural disaster events, other effects of climate, they hit households hard and directly, and politicians want to be accountable to that. The mitigation agenda has a lot of challenges around that, but I think the motivation here for governments, the signals are already strong. We need them to act accordingly, and we're trying to accelerate that.
That's great. Abhishek?
I would say, just as an example, right, capping the liability will help some of these customers use the money more judicially. If the liability is uncapped, there is fear and reckless spend can happen. So the money doesn't do the same dollar does much less, right? So I would say capping liability would be more important.
I'm going to cheat a little bit, so I'm going to claim credit for my last point around going from a regulatory reporting obligation mindset to an investing pragmatic implementation mindset. So I'm going to claim credit for having said that. But the other one I'm going to say, there are frictions that keep market pricing and market mechanisms from doing their job. Right? And so a good example, we asked our mortgage traders to look at, great, let's think about differential physical risk, diversified pool of mortgages. They said, well, here's the problem. They're all seen as being guaranteed by the US government, so they may have different physical risk, but the financial risk is identical. Within insurance markets, we see a lot of regulation that keeps the actual risk from showing up in pricing, which means the business case and ROI for better data or better tools goes away. So I think some of it would be mindful of what are the frictions that keep price signals from actually doing their job and showing the real ROI of resilience and adaptation spending.
Great. And with that, we will leave you to cocktails in a bit. Please join me in thanking my speakers for a wonderful discussion.